All right, so important things that you're going to be using for the remainder of this course. So you do want to focus in. Learning objective number 3, distinguish between direct and indirect costs. Now you see this term cost object. And when you see that term cost objects, most of us think of something physical, an object, something that you can pick up and run away with. But what I'm going to suggest to you that is in this context, when we say the term or when we use the term cost objects, I want you to think of the term objective. What is the objective? This is kind of weird, but we're talking about cost objective, cost objects, cost objectives. What is it that we're trying to achieve with tracking our costs? In other words, are we tracking costs by products? Are we tracking costs by departments, by geographical segments, all these individual units, models, marketing strategies, geographic business segments, departments, sustainability? What is our cost objective? I know we're calling it cost objects. I know that. But think of objects as if you're really just using a shorter term for objective. When we're talking about direct cost, the term direct cost, we're talking about costs that can be traced to the cost object or objective. And when we say what it can be traced, it's readily associated with the cost object. And one thing that we just have to remember, which is sometimes difficult to remember, but remember when we say a direct cost, and we say that it can be traced to the cost. Well, any cost really, in the end, can be traced to its object. But because we have limited resources and limited time, and we just can't do everything at once, then what we're going to call direct, we're going to add something to this. I want you to add something to this. It's costs that can be traced to the cost objective that it's economically feasible to do this. In other words, we can't spend $1 million to trace a cost that's only going to add about a couple of pennies to the final product, because that's way too expensive. You'll find a way to trace it, you'll find a way to find it, but it's just too expensive. So when we say direct, we have to always remember economically feasible. Indirect costs are costs that relates to the cost of object, but cannot be traced specifically to the object or the objective. And when we say cannot, well, like I said, there's really no such thing as cannot. It can be, but it's just not economically feasible. It just takes too much time and effort to do that. So with that, then we're just gonna assume that it can't be traced, because it just costs too much money to do that. Are direct costs economically feasible to trace to the cost object? Indirect costs are not economically feasible to trace to specific objects. Now, when we're talking about assigning direct and indirect costs to a cost object, we're going to go in two different directions. If it's direct, then we can trace it. We can trace the direct cost to the cost object. We do that, and then the amount of cost is assigned to the cost object in a very precise manner. The example I'm going to give you, just so that we get a head start on this, is, and we'll be exposed to it more, is that, whenever we manufacture a product, we're going to have a lot of labor involved. Some of it is what we're going to call direct labor. In other words, we can take that labor, some of the labor, we can trace it to the specific object. How much time does Joe Schmo spend on manufacturing this specific product? There are going to be some costs that we can't do that. So for example, let's say we manufacture 500 different items, and we have a manager that is overseeing all of it. If the objective or cost object is the product, then that's going to be difficult, if not impossible, to trace the manager's cost to every single one of these products, these units, if we're producing 500 different units. So whenever we come across something that is not economically feasible to trace, then we refer to them as indirect costs. And when there are indirect costs, we don't trace them to the specific items. We do what's called allocate. We allocate those costs to the cost objects. Okay. So trace is direct, allocate is indirect. Now, the point being is that all costs are going to ultimately be assigned to the cost objects. The only question is can we trace it directly, or do we have to allocate the costs? Objective number 4, identify product costs and period costs. When we're talking about costs for internal decision making, we're trying to consider all costs incurred across the value chain. Well, the value chain is what we talked about earlier. Got the list, that slide there, those costs associated with the value chain. The total costs are all resources used throughout the value chain. The value chain, the bulk of it is going to be through production, but you do have your marketing costs, you do have your distribution, you do have your research and development, but the bulk of this total cost is really going to be associated with manufacturing or the production. And the reason why we want to know all of these costs is because when we set our price, the price must cover all costs plus return a profit. If we can't generate a profit, then our investors aren't going to be happy. They're not going to get any money back. They're not going to be real thrilled with investing in our organization. So we've got to be able to cover our costs and then generate a bit of a profit. The larger the better, right? Generate a profit so that we can sustain our business. Now, that's what we just talked about, was about internal reporting. That was the previous slide. This slide focused on external reporting. This is something we're not going to focus on in this class, but we're going to talk about it briefly at this point in time so we have a reference point. The cost for external reporting is about what you learned in Accounting 1, and that is the financial statement production, the 4 financial statements, including the income statement, the statement of retained earnings, the balance sheet, and the statement of cash flows. All of those are consistent with generally accepted accounting principles. Now, even at then, though, there are some provisions for accounting for our product costs. The product costs, when we're talking about generally accepted accounting principles, the product costs incurred by manufacturers to produce their products or by merchandisers to purchase their products. So we're talking about the product costs. When you hear product costs, I want you to think inventory. Whenever I have a product costs, that cost first goes into inventory. Now, when you learned in financial accounting, you buy your inventory, right? You buy it. Let's say you buy a computer, it costs the company $1,000 or the merchandiser $1,000. That $1,000 goes in an inventory, and then when you sell it, it gets charged to the cost of goods sold. Hopefully, you remember that process. But for a manufacturer, the manufacturer doesn't buy products to resell. They build the products. So now we're talking about all the costs. The product costs really become all the costs that are necessary to produce the product. That's why they refer to it as product costs. Now, even at that, there's going to be some costs that are not going to be considered part of the product costs. They're not going to be part of the inventory. Those costs are referred to as period costs. And the reason being is because they're not going to go into inventory. Remember, inventory is an asset. So just to go back to the product costs, we're going to charge all our product costs to inventory. That is an asset. If you recall the definition of an asset, that's a cost that has future value. So it sits in inventory until it's sold. It generates a sale. Period costs don't do that. Period costs don't go into inventory. They get charged to the income statement immediately or in the period in which they were incurred. So the example of period costs would be operating expenses. selling and general and administrative expenses. See, these have nothing to do with manufacturing. These are like our accounting people that are working in the office. These are like our salespeople working in the office. You have like receptionists, you have administrators all working in these offices. Those are operating expenses, and they are considered period costs. They're charged to the income statement immediately. They're an expense. They don't get added to product costs. They don't get added to inventory. So here's an example of your total costs for 2017. You have your product costs and you have your period costs. Well, first we'll start with our product costs. Those are all the costs associated with production, and it says here they're initially recorded as inventory. So these product costs go into inventory, and they're either going to be sold in that year. So if they get sold, if it's sold in that year, they first go into inventory. If it's sold, then that cost takes out of inventory and charged to the cost of goods sold. If the product isn't sold, it stays in inventory. And if it stays in inventory, it's reported on the balance sheet. So the cost of goods sold is reported on the income statement. The inventory is reported on the balance sheet. All right. Not until it's sold, and this is the following year, just so that we're following. These are 2017. The following year is 2018. When we actually sell that inventory in the following year, then it gets charged to the cost of goods sold. The point being is product costs go in inventory that stays on the balance sheet until the product is actually sold. Period costs, on the other hand, such as research and development, design. Period costs, on the other hand, such as research and development, design, marketing, distribution, customer service, all of these costs are considered period costs. These costs are just charged immediately to the income statement. It's going to be part of operating expenses. Remember, on your income statement, if you don't, you'll have to reflect upon your textbook or your previous notes. Cost of goods sold is right under sales. Okay, cost of goods sold, you have your sales minus your cost of goods sold. The cost of goods sold is what you sold. That's the inventory numbers or dollars that are charged to the cost of goods sold after you sell a product. Period costs, on the other hand, are costs that never go into inventory. They're just charged as an expense directly to the income statement. A merchandiser, following the same logic of what we just reviewed in the previous slide, we have our merchandising company's total costs. They will include product costs and period costs, all right? And the product costs include the cost of the merchandise itself, the freight in and custom and duties. The period costs are all the costs that are incurred, or all other costs incurred by the company that isn't considered part of the product costs. So here's an example, a little bit of a graphical representation of manufacturing companies and the production of their products. You'll start off, it looks like we're looking for, we'll start off with direct materials. Direct materials, in this example here, you see tires, some other parts. Looks maybe like some metals or something. So you have all these direct materials that we're going to use. When you hear the term direct materials and raw materials, they can often be used interchangeably. Sometimes people refer to them as raw materials. In the context of raw materials, it just means it's the materials you're going to be using to manufacture a product. Direct materials, though, give you a better, is a little bit more specific because it gives you the materials that are going to trace directly to the product. So we're going to get the direct materials. We're going to add to that some direct labor. Those are people manufacturing or working on the manufacturing plant. Now, in addition to that, we're going to add to that manufacturing overhead. And you know, you see the whole plant here. When you see this whole plant, we're thinking, well, it's not the whole plant, but somebody had to pay rent for that plant. Somebody had to pay the janitorial services for that plant. Those are all costs that are still part of the product itself. The production costs include materials, labor, and manufacturing overhead. And overhead means all the manufacturing costs that are really not considered either direct materials or direct labor. Don't get confused though. Accounting is not a manufacturing cost. A sales and marketing is not a manufacturing cost. But a janitorial service maintaining the manufacturing plant, that is a manufacturing overhead. The repairs and maintenance, repairing those machines that are running, that is a manufacturing cost. So you have direct materials, direct labor, manufacturing overhead. All three of these costs together will then equal the total product costs. Direct materials, primary materials that become the physical part of the finished product. Direct labor, the cost of compensating employees who physically convert raw materials into the company's product. And manufacturing overhead, all the manufacturing costs other than direct materials and direct labor. So more specifically, we're talking about indirect materials, we're talking about indirect labor, and indirect manufacturing costs. So this is how the summary of a manufacturing company's total cost might look like. You have the manufacturing's total cost, the total cost of a manufacturing company, which includes the product costs and the period costs. We've actually already talked about this. Product costs are those product costs, those are the costs that actually are used for the product. And period costs are costs that are just operating expenses, and they get charged directly to the income statement. Period costs, they don't become part of inventory. But our product costs can be broken down into three parts: direct materials, direct labor, manufacturing overhead. I do want you to focus on these three terms because you're going to use these three terms over and over and over again. It's going to be almost for the entire part of this course. Direct materials, direct labor, manufacturing overhead. Manufacturing overhead, broken down a little bit more specifically, include indirect materials, indirect labor, and other indirect manufacturing costs. A couple of more terms that you need to learn because they are relevant both now and later into this course. What we call prime costs. We're simply going to take direct materials and we're going to add to that direct labor. When we add those two together, we come up with what we refer to as prime costs. Conversion costs are equal to manufacturing overhead plus direct labor. Those two added together give us the conversion costs. We talk about additional labor compensation costs. It's not just the salary and wages, although that's what we're going to talk about first. First, we start off with the salary and wages paid to the employees. But the additional labor costs will include any fringe benefits paid. So health insurance, retirement plan contributions, payroll taxes, paid vacations, cost on additional 35% beyond gross salaries and wages, workers' compensation benefits. All those are going to be added to labor costs, even direct labor.